Hey there, it's Ryan Skaggs, and this is the Mortgage Minute. Thank you so much for tuning in. This channel is dedicated to everything real estate, mortgage, interest rate. So let's dive right in. This week, we're going to talk about the cost of waiting. Now, I've probably done 50 videos on this over the last few years and everything else, but more and more in this seller's market, in this hot market, it is continually we have examples. I am going to show you a text message chain that I got from a client making an offer saying 7 other offers, one of them all cash. Absolutely craziness in this market. And this is suburban Chicago. So we're not anything like California, Texas, some places in Arizona, Florida that are just like total chaos. With that said, I continue to get the question from clients and from partners, from real estate agents is, maybe they have to pump the brakes. Maybe they have to let the market calm down. So we're going to talk about exactly what that means. And to give you an example, we're going to talk about a $500,000 home. The home is worth $500,000. We're all going to agree upon that. We're going to put 10% down. Now, in this first column, I have now dash overpay question mark. You got to pony up and pay $525 to get this property. So you have to pay a 5% premium to get this property today. All right. Here's our kind of our constant. Now, if rates are at 3, we got to pay $525. Now we come down here, our payment is $28.96. Now, what happens if we wait? If that's 3 months, 6 months, maybe we look at it next spring, what would that be like, right? So now that $500,000 property you don't have to overpay for, or maybe somebody did overpay and then the market starts to come back down by say 5%, and it's back down to 500. Or let's imagine in the scenario that, hey, they don't have to overpay. Now it's more of a balanced market and 500 is going to get it, right? Or maybe they pay just under. So now we're at 500,000, but we see rates higher. Everything is pointing towards, inflation starting to take place. Everything is pointing towards rates start to head up. Let's look at the rate chart while we're doing that. As we see the average 30-year fixed at 2.95. This is as of May 27th, 2021. Check out the link below or right here at the top, freddiemac.com/PMMS. You can start to see where we went up. Now it kind of came back down. Let me show you the 3-year version. So we've got this big downward trend, right? And now we've started to head back up and then we've kind of settled down. So what happens from here? Do we start to head back up or do we kind of settle into this area? Time will tell. But if we do start to head back up, my point would be is that let's imagine interest rates move up to 3.5. Not a huge move. We could definitely see that, honestly, in a week or two, but likely maybe a couple quarters when they start to trend back up. Now, if that $500,000 home is at 3.5%, we look at our payment. If you bought it right now and quote unquote paid up to get it, your payment's $24 cheaper because rates are so darn low with everything else being the same. Okay. So take all this other stuff out of the equation. Take all this other highlights out. Let's look at it plain and simple. Your monthly savings is $24. Now you can get super granular as a financial advisor might of how much you're paying to a principal or an accountant might. But with that said, to most consumers, it's a matter of their payment, right? So you can own the home now and potentially paid up to get it. And then have a really nice lunch one day if you're even going into the office. Or you can choose to pump the brakes and look in the future. Knowing these numbers and knowing how the breakdown happens is so incredibly important. If you want to see these numbers, reach out. I can definitely give you some examples on what's the savings over 5 years, what's the principal paid in 10 years, give you some different viewpoints of, hey, you're going to save about $8,500. You're going to pay principal of about $113 versus $101. Now you start off with a higher loan amount, right? So there's pros and cons to every single bit of this, but it's worth understanding that there's a lot of different kind of pieces that go into this melting pot of is now a good time to buy. So my contention would still be is rates are extremely low. I do not want you to overpay for a home. That is absolutely positively not what I'm suggesting. Not going in and just overpaying than what the market is just so you get something, right? That's not going to help you over the long term. That's likely not going to help you. Now, one point I would make to you as well is if you're going to hold the home for 10 years, Do you really care what the property's worth in 1 to 2 years? If you think there might be a little lull and then we'll average back out and start to slowly go back up, then think about where you want to be in that 10-year period, not where you're going to be in that 1-year period, because rates are literally at historic lows. So this is the Mortgage Minute from Ryan Skaggs. Thank you so much for tuning in, and we'll see each other again very, very soon.